Welcome to Modern Day Economics, where we discuss economic issues and events that affect our families and communities. Today, we have a very important episode. Talk a little bit more about inflation. The new CPI numbers just came out yesterday, August 10th, and we got annualized inflation right now, a little bit lower than expected at 8.5%. So the forecast analyst consensus was 8.7%. The last number that we had was 9.1. So a little bit of an improvement. And some may think, well, inflation's going down, and some may be very positive of this. But let's really look at this contextually. Let's look at this in context and accurately. Does inflation going down mean that prices are going down? Absolutely not. If we have what would we call disinflation, so a slowing rate of inflation, doesn't necessarily mean that your home that used to cost X and now is worth a lot more, all of a sudden is worth what it was before. No, it just means that it goes up at a slower rate. And that goes for any other goods and services that are captured under the Consumer Price Index. But not only that, we also have to think and consider that in no historical time of increase in inflation, we can look at the 70s as an example of this, does inflation go up in an exactly straight line? So, certainly, it's a positive on the consumer's side that's looking to purchase goods and services, especially essential goods. That inflation is now 8.5% rather than 9.1%. But we certainly have to look at this contextually and see what happens. See what happens in the next reads if these numbers are revised. It's also very important to consider that the Fed's funds rate is significantly lower than the inflation number of 8.5%. Historically speaking, if we go back to other periods of high inflation, when then Chairman Paul Volcker of the Federal Reserve decided to fight inflation, what needed to be done was to raise Fed funds rate, the interest rates that the Federal Reserve has the ability to set above the rate of inflation. So, considering this, inflation CPI, at least headline CPI, was 13%, I believe, on that year of 1981, and they raised rates to 18%. So we really got to consider that the target for this year for Fed funds is, I believe, under 3%, and we're talking about 8.5% inflation. So it's really interesting to consider contextually if by raising interest rates on an amount that is that low, if that is even a possibility to tame inflation. So it's certainly positive news, but it should be important to look at it contextually and to really take into consideration that we'll have to see what happens in the next releases to really see if inflation has in fact peaked, as many news sources might say. I would caution people of coming to that conclusion necessarily because inflation doesn't necessarily go up in a straight line. Um, we're also in a context of two consecutive quarters of negative GDP, and we will have to see what is occurring with that. There have been some layoffs reported in the news in the tech sector specifically. So that's also something to really look out for if that is something that'll be extended to other segments of the economy, because that would add to the recession argument certainly. And when you have a contracting gross domestic product added to inflation, so you got on one hand people that are just generally worse off because of recession, and then you have increasing price pressures on them that go above their rate of increase in wages. That just further deepens the negativeness of their position. So, definitely things to take into account. 8.5% is an improvement as compared to the previous of 9.1%, and it is an improvement compared to the 8.7%. But I would caution people to get too optimistic on this number. inflation does not always go up in a straight line. It never goes up in a straight line, quite frankly, at least historically speaking. This is important to be considered along with future data as well. Thank you for listening to Modern Day Economics. Stay tuned for more economic news and events.